Right now, thousands of people across the UK are trying to get a mortgage and getting rejected, even when everything on paper looks completely normal. People with stable jobs, years of work history, healthy savings, clean credit files, and sensible spending habits are suddenly being told we're unable to assist you at this time. And this is happening at a scale many borrowers have never seen before. So the big question is, why are UK banks rejecting so many mortgage applications, and why does it feel like the rules have suddenly become impossible? And even more importantly, what can you actually do to fix it, so you finally get approved? To understand this, you first need to know one thing: banks in the UK are operating with fear. After 2 years of rapid interest rate hikes, huge market uncertainty, and thousands of households moving from cheap fixed rates to much higher ones, lenders have gone into a defensive mode. Even though interest rates might be stabilizing or falling now, banks are behaving like rates could jump again without warning. They're terrified of approving borrowers who may look safe today but could struggle in the future if the economy changes. That fear has reshaped the entire lending system. The first major reason applications are rejected is the new, harsher affordability stress tests. Many people don't know this, but when you apply for a mortgage, the bank does not check whether you can afford the current interest rate. Instead, they calculate your affordability at higher imaginary rates, sometimes 7 or even 8%, just to see if you could survive a financial shock. So even if the actual mortgage rate is 5%, your borrowing power is tested at a much higher number. This instantly reduces how much the bank thinks you can afford, and millions of people fail without ever knowing why, because the bank will never tell you the details. The second reason is internal credit scoring, which has nothing to do with Experian, Equifax, or TransUnion. You could have a perfect external score, but the bank's internal algorithm might reject you instantly. Their system looks for tiny patterns. Maybe you dipped into your overdraft once. Maybe you made a few credit checks recently. Maybe your income looks irregular. Or maybe your spending pattern doesn't look predictable enough. Even small behaviors trigger risk flags, and the application is rejected before a human ever sees it. This combination of harsher stress tests, tighter risk rules, and automated internal scoring is why so many people receive sudden rejections, even when they did absolutely nothing wrong. Another huge reason UK banks are rejecting mortgages is something called payment shock. Over the last few years, millions of homeowners were locked into extremely low fixed rates. Some people were paying 1% or even less. But now, as those deals end, their payments are doubling or even tripling. Banks know this. They see the data. They know a wave of financial pressure is hitting households across the country. So even if you are a first-time buyer who has never had a mortgage before, lenders are tightening rules for everyone because they are preparing for a rise in defaults. The rejection you get isn't really about you. It's the bank protecting itself from future risk. Another silent rejection reason is updated living cost assumptions. Banks no longer trust what people say about their monthly expenses. Instead, they use internal models that assume you spend far more on food, transport, child care, utilities, insurance, and everyday living costs than you actually do. Even if you live cheaply, even if you save aggressively, the bank doesn't care. Their calculator automatically reduces your borrowing power. You could think you're financially strong, yet the lender's computer decides you're stretched. This is one of the most common hidden reasons people fail affordability. Then, there's document and fraud scanning, something most applicants don't realize is happening. Banks now use advanced AI systems to scan your bank statements, payslips, proof of address, and all supporting documents. If anything looks inconsistent, a tiny spelling difference, mismatched dates, different employer names, or unusual deposits, the system flags your case as high risk. Many applications get rejected before an underwriter even reads them. Even completely innocent things, like transferring money between your own accounts, can raise suspicion if the pattern looks unusual. Your bank statements have become one of the most powerful parts of your application. Lenders go through the last 3 months line by line. If they see heavy use of your overdraft, excessive subscriptions, large cash deposits, gambling, cryptocurrency transactions, payday loans, or irregular spending patterns, they classify you as unstable. You could be earning a strong salary but still be rejected because your statements don't look clean and predictable. Even your income can work against you. If your salary varies, if your bonuses aren't guaranteed, if your overtime isn't consistent, or if your employer pays you on different dates, banks sometimes treat your income as unreliable. This alone can reduce your borrowing amount dramatically or lead to a straight rejection. And again, the bank won't explain this to you directly. All these factors combined create a situation where normal people with normal finances are being turned away, but the good news is, once you understand these invisible rules, you can prepare yourself properly and fix almost every one of these issues before you apply. Now that you understand why banks are rejecting so many applications, let's talk about how to fix it, step by step, so your mortgage has a high chance of approval. The first and most important rule is stop doing random credit checks Every time you use a comparison website or check your eligibility online, it counts as a soft search. Too many of these within a short period make lenders nervous. It signals financial stress or desperation. For the next few months, do not click any mortgage calculators or see what you could borrow tools online. Wait until you are fully ready to apply. Next, clean your bank account and spending patterns For the 3 months leading up to your mortgage application, act as if a lender is watching every move because they are. Avoid overdrafts entirely. Stop gambling apps. Reduce transfers between accounts. Keep deposits simple and explainable. Any unusual movement, even if perfectly legal, can be interpreted by banks' automated systems as suspicious. The goal is to maintain stable, predictable, and clean accounts A spotless 90-day bank history can turn a previous rejection into an approval. Step 3 is fixing your debt-to-income ratio This doesn't mean you have to clear all debt, but it does mean reducing your monthly outgoings. Even paying off one credit card or reducing loan repayments can make a significant difference. Banks don't just look at your total debt, they care more about how much you pay every month. A small adjustment here can increase your borrowing power by tens of thousands of pounds. Step 4 use a whole market mortgage broker not a bank advisor or a generic online platform. Each bank has different appetites for borrowers. Some prefer self-employed applicants, some prefer people with consistent salaries, some prioritize deposit size over credit history. A broker knows which lender is most likely to say yes to your profile. They match your financial story to the right bank, avoiding unnecessary declines and saving you weeks of frustration. In fact, this alone can improve your chances more than any other step. Step 5 is stability across every document Your employer name must match on payslips, bank statements, and ID documents. Your address must be consistent everywhere. Your income must arrive consistently over the past 3 months. Avoid changing jobs or moving addresses during this period. Banks now look at the last 90 days more closely than your entire work history. Inconsistencies in this short period can trigger automatic rejections, even if your overall profile is perfect. Step 6 is to avoid moving money around before you apply. Many people think transferring savings between accounts or consolidating money into a new account will help their mortgage application, but in reality, banks see this as unclear or suspicious activity. Keep all your savings stable and visible for at least 2 to 3 months prior to applying. The goal is to show a calm, predictable financial footprint. Lenders trust consistency far more than sudden bursts of activity, even if it's perfectly legal. Step 7 is to explain your story if there have been issues in the past. Missed payments, overdrafts, job gaps, or temporary financial difficulties are all factors that could have caused rejection. But these do not have to be permanent barriers. A professional mortgage broker can help you submit a clear written explanation. Human underwriters do read these notes. If your story makes sense and demonstrates responsibility, lenders often approve applications that would otherwise be automatically declined by the system. Step 8 is to build a perfect 90-day profile ***. This is one of the most powerful strategies you can use to increase approval chances. During this period, ensure your income lands on time and consistently. All bills and payments are made promptly. No new credit accounts are opened. Your spending is predictable and matches the pattern of your regular income. Addresses and employment details must match across all documents. Essentially, your financial life should look calm, orderly, and stable. When banks see this pattern, their algorithms and human underwriters alike feel confident approving your mortgage. Another critical point is understanding lender-specific preferences ***. Different banks have different appetites for risk. One bank might reject you immediately due to minor factors in your profile, while another bank may accept you without issue. This is why applying blindly to the first bank you find is rarely effective. Using a broker to match you with the lender who prefers borrowers like you is essential. Rejections are often not a reflection of your financial worth, but simply a mismatch between your profile and that lender's risk tolerance. Finally, it's important to remember the bigger picture ***. Banks are not rejecting people because they cannot afford a mortgage. They are rejecting them because the system is designed to anticipate risk in a volatile economic environment. Once you understand these invisible rules, apply the steps of cleaning your finances, stabilizing your accounts, reducing debt-to-income ratios, maintaining a perfect 90-day profile, and using a knowledgeable broker, you dramatically increase the likelihood of approval. The process is about strategy, preparation, and aligning your profile with lender expectations. At this stage, you should have a clear understanding of why UK banks are rejecting so many mortgage applications and, more importantly, how to fix it. The key takeaway is that approvals today are not just about income, credit scores, or savings. They are about how banks perceive risk, how your financial behavior appears over the last 90 days, and how well your profile matches the lender's internal model. One final strategy is to plan your application timeline carefully ***. Do not rush. Many people apply immediately after changing jobs, moving house, or consolidating accounts. Each of these actions can create small inconsistencies that trigger automatic declines. Waiting 3 months after any major financial or personal change allows your profile to settle, giving you a much better chance of success. Another critical factor is document preparation ***. Make sure all payslips, bank statements, proof of address, and identification documents are consistent, complete, and clearly legible. Mistakes, gaps, or mismatched information are one of the most common reasons applications are delayed or rejected. Take the time to review everything thoroughly before submitting. A small oversight can lead 2 weeks of frustration or outright denial. Also, remember that banks favor borrowers who show stability and predictability ***. Regular income, consistent spending patterns, and a history of responsible financial behavior are far more persuasive than a high salary or large deposit alone. Even small habits like frequent overdraft usage, late payments, or inconsistent deposits can drastically reduce your chances. Essentially, the banks are looking for patterns that demonstrate you will continue to behave responsibly over the lifetime of the mortgage. Working with a professional broker remains one of the strongest advantages. Brokers know lender preferences, hidden rules, and internal scoring tendencies. They can present your profile in the best possible light, match you with the right lender, and even help craft explanations for any past issues. Many borrowers get approved after multiple rejections simply because a broker guided them to the right lender. In summary, UK banks are rejecting mortgages not because people are unworthy or unqualified, but because lenders are extremely cautious, algorithms are sensitive, and invisible rules have become stricter than ever. By following these steps, stopping random checks, cleaning your bank accounts, reducing debt-to-income ratios, maintaining a perfect 90-day profile, stabilizing old documentation, planning your application timeline, and using a knowledgeable broker, you can overcome these hidden barriers. The process may take patience and preparation, but it is achievable. With strategy and careful attention to detail, your mortgage approval is no longer just a hope, it becomes a predictable outcome. Success is about understanding the system and working with it, not against it.